Imagine waking up on a Monday morning and realizing the entire financial system might stop working. Not slow down, not enter a recession, stop. ATMs not working, companies unable to access credit, payrolls possibly not going out. That almost happened in 2008. And here's the thing, it wasn't a random accident. It wasn't just bad luck, and it definitely wasn't unpredictable. It was a chain reaction, small decisions at first, that built a financial time bomb inside the U.S. economy. Today, I'm going to show you how home loans turned into financial weapons, how Wall Street transformed risk into safe investments, the exact moment the system started collapsing, and why, for a few terrifying days, the United States was dangerously close to total economic failure. And at the end, I'll tell you what almost happened the day the government decided we're not saving everyone. Because that decision changed everything. Look, every major crisis begins with a story that sounds too good to be true. In the early 2000s, after the dot-com crash and the September 11th attacks, the Federal Reserve slashed interest rates. Money became cheap, really cheap. And when money is cheap, people borrow, especially to buy houses. The American dream has always centered around home ownership, stability, a yard, a future. Banks started lending to almost anyone who wanted a mortgage. And when I say anyone, I mean anyone, including people who didn't have stable income, already had high debt, or barely had a credit history. These were called subprime loans. And here's the detail that changed everything. The banks didn't care much whether borrowers could repay because they weren't planning to keep the risk. Instead of holding on to these mortgages for 30 years, banks began selling them. And this created a financial product that for several years was considered almost bulletproof. But hidden inside it was a massive flaw. And when that flaw started cracking, the entire system began shaking. We're getting there. Let's simplify something that sounded extremely complicated at the time. Imagine a bank issues 1,000 mortgages. Instead of waiting decades to collect payments, it bundles those mortgages together and sells them to investors. That bundle is called a mortgage-backed security. Investors were essentially buying the right to receive mortgage payments. So far, that doesn't sound crazy. But Wall Street didn't stop there. They divided these bundles into layers, called tranches. Some were labeled ultra-safe. Others were riskier. Then came the next invention, the collateralized debt obligation, CDOs. Here's where things get dangerous. Many CDOs were filled with subprime loans, the riskiest ones, but rating agencies gave them top ratings, AAA, nearly as safe as U.S. government bonds. And here's the question hardly anyone asked at the time. How did risky debt suddenly become safe? The answer involves a conflict of interest. Rating agencies were paid by the very banks creating these products. Yes, exactly. In 2006, housing prices started falling. Slowly, at first, then faster. And when prices fall, homeowners who bought at the peak suddenly owe more than their home is worth. That's called negative equity. Many simply stopped paying. Now imagine that happening nationwide. Thousands of defaults turned into millions. Suddenly, those safe mortgage securities were filled with loans that weren't paying anything. CDOs began losing value. No one knew what they were truly worth. And when nobody knows what something is worth, nobody wants to buy it. The market froze. In 2007, funds connected to Bear Stearns collapsed due to heavy exposure to subprime mortgages. It was the first serious warning, but many believed the damage was contained. Then 2008 arrived. In September 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history. And here's the crucial part. The government chose not to rescue Lehman. They believed markets needed discipline, that not every institution should be saved. The reaction was immediate: panic. If Lehman could fail, who was next? Banks stopped trusting each other. And when banks don't trust each other, they stop lending. And when lending stops, the economy stops. But there was one institution even more dangerous than Lehman. And when it started collapsing, the government switched into full emergency mode. Because if it failed, it wouldn't just hit Wall Street, it would hit the world. The insurance giant AIG had sold billions of dollars in credit default swaps, basically insurance against mortgage securities failing. The problem? They didn't have enough reserves to cover massive defaults. When mortgage securities collapsed, AIG was on the brink. If AIG had failed, banks across the globe would have suffered catastrophic losses overnight. This time, the government stepped in, over $180 billion in support. Congress approved the Troubled Asset Relief Program, TARP, $700 billion to stabilize the system. It was controversial, deeply unpopular. But here's the uncomfortable truth. Without it, many economists believe the financial system could have fully collapsed. And when the financial system collapses, it's not just Wall Street, it's jobs, businesses, retirement savings, families. What followed became known as the Great Recession. Millions lost jobs. Homes were foreclosed. GDP contracted sharply. Global markets spiraled. Recovery took years. Here's the most important point of this entire story. The crisis wasn't just about housing. It was about trust. Modern financial systems run on trust. Banks trust other banks to repay loans. Investors trust asset values. Businesses trust credit will be available tomorrow. When that trust disappears, the system locks up. And for a few days in 2008, that trust nearly vanished completely. After the crisis, regulations tightened. Banks were required to hold more capital. Stress tests became routine, but the debate continues. Did we truly fix the system, or did we simply create new forms of risk? Because here's something unsettling. Before 2008, many believed the system was too sophisticated to fail, that mathematical models controlled risk, that diversification eliminated danger, and yet it nearly collapsed. Let's make this crystal clear. The U.S. economy nearly collapsed in 2008 because easy credit fueled a housing bubble. Risk was disguised as safety. Incentives were misaligned, and when prices stopped rising, the structure imploded. But the true trigger? Psychology. The moment markets realized no one truly understood where the risk was hiding. When that realization hits, fear spreads faster than any financial contagion. Now think about this. Every major crisis looks obvious in hindsight, but in the moment, it looks like growth, innovation, opportunity. Maybe that's the biggest lesson of 2008. It wasn't just about mortgages. It was about incentives, overconfidence, and how complex systems can appear stable right up until they crack. If you want to understand future crises, you have to understand this one. Because the real question isn't whether another crisis will happen, it's where it's forming right now. And that is a story for another video.